You paid on time. You kept your job. You did what responsible people are told to do. Then, three digits you did not calculate quietly changed the price of your life. In the Consumer Financial Protection Bureau's current mortgage comparison, changing the example score from 625 to 700 can change the lifetime cost of a $400,000 home by as much as $264,523. That is not a grade. That is a price tag. And if nobody ever explained that difference to you, that was useful to everyone making money from the transaction. The score can follow you to the mortgage desk, the car lot, the apartment application, and in many states, the insurance quote. But here is the first secret. The score is about you. You are not the customer. The customer is the business deciding whether to approve you and what you will pay. Stay with me, because the most expensive part may not be the score itself. It may be one wrong line buried underneath it. To understand how we got here, go back to 1956. Engineer Bill Fair and mathematician Earl Isaac founded the company that became FICO. Their idea was powerful. Replace a loan officer's instinct with a repeatable statistical model. That solved a real problem. Before standardized scoring, lenders could hide favoritism and discrimination inside words like judgment, character, and neighborhood quality. A formula could force similar files through similar rules. But a tool built to remove one kind of unfairness can still create a different kind of power. The first general-purpose FICO score arrived in 1989. For decades, the person being measured rarely saw the machinery. Lenders bought the answer. Consumers lived with the price. Your financial life became the raw material. Somebody else became the paying customer. And then that scoring model became more than a tool. In one of the biggest lending markets in America, it became the road nearly everyone had to use. For decades, mortgages sold to Fannie Mae and Freddie Mac generally relied on classic FICO. That meant lenders had little practical choice about the score required for those loans. Think about what that means. You cannot reasonably shop around a requirement when almost every road leads through the same booth. Each score request is part of a business transaction. The exact price varies by model, reseller, bundle, and use. But the structure is simple. A company can be paid when another business requests a score about you. Your data goes in, a price comes out, and the person carrying the consequence is standing outside the sale. Now, finally, another road is opening. In April 2026, federal housing regulators moved into a new phase. Approved lenders can now deliver eligible loans using either Classic FICO or VantageScore 4.0. FICO 10T remains part of the broader modernization plan. That does not make the system transparent overnight. It does mean competition has entered a place where one dominant model held extraordinary power for years. If you want rules like this translated before they cost you money, subscribe. That is what we do here. Because the next secret is where ordinary people accidentally hurt themselves while trying to be responsible. You may have heard that carrying a credit card balance helps your score. It does not. You do not need to pay interest to prove you can use credit. A card can report normal activity and still be paid in full by the due date. Paying interest is not a scoring requirement. What matters is what the account reports. Credit utilization is the share of your revolving limits showing as used when the lender reports the balance. If a card has a $10,000 limit and reports a balance of $5,000, the system sees 50% utilization, even if you plan to pay it off days later. So a person can pay in full, avoid every late payment, and still get priced from a snapshot taken before the payment landed? That is why timing matters. It is also why closing an older, no-fee card can backfire. The moment that available limit disappears, your utilization can jump even though your debt did not. You did not spend another dollar. The picture of you changed anyway. But a confusing rule is still not the worst part. The worst part is paying for information that was never yours to fix because you never knew it was wrong. A Federal Trade Commission study found that 1 in 5 participants had an error on at least one of their 3 credit reports. 5% had an error serious enough that it could lead to less favorable credit terms. 1 in 5. That can be somebody else's account. A payment marked late when it was not. A balance that should have disappeared. An address tying your file to the wrong person. The model can calculate perfectly and still produce a damaging answer when the file underneath it is wrong. And when that happens, you can pay more for a mistake you did not make. You can do your part and still be punished by somebody else's bad data. This is where we stop being impressed by the machine and start protecting the person standing in front of it. Here are the 5 moves. First, inspect the files under the score. AnnualCreditReport.com is the federally authorized place to request your free reports. Check all 3. They are not always identical. Do this before a mortgage, a car loan, or an apartment application. Do not discover an error while somebody is waiting to price you. Second, dispute information that is not yours or is being reported incorrectly. Keep the records. Save the confirmation numbers. Make the system answer you in writing. Third, pay on time and keep reported revolving balances low compared with available limits. But do not send a bank interest just because somebody told you debt builds character. It builds their revenue. It is not required to build your score. Fourth, think before closing an older, no-fee card. Closing it can shrink your available credit and change the age profile of your accounts. Protect yourself from fraud, but understand the scoring consequence before you cut the line. Fifth, when shopping for a mortgage, ask which scoring model the lender is using and whether the newer, approved option applies to your loan. In 2026, that question is no longer theoretical. None of these moves makes the system fair. They do something more immediate. They stop the system from catching you asleep. You were not stupid for missing this. The rules were scattered across disclosures, models, reporting dates, and business contracts you were never invited to read. My job is to pull those rules into the light before they take another dollar from you. The score is not your worth. It is not your discipline. It is not a moral judgment. It is a risk pricing tool sold into a market. They did not build a mirror. They built a toll booth. Now you know where it is, you know what it reads, and you know the 5 moves that keep a hidden mistake from setting the price without a fight. Join the community waitlist at theykeepyoubroke.com, and I will send you the free Life Under Pressure kit. No daily noise, just the next move. Subscribe Send this to the person who still thinks paying interest helps their score. And remember, the number may be about you, but it does not get to define you. Educational content only, not financial advice. Sources and dates are in the description.